Japan's economy is facing a rough patch, with unexpected shrinkage and rising prices putting the squeeze on households. As the Bank of Japan considers a shift from its long-standing easing policies, how will this impact the nation's financial stability and consumer spending? Let's dive into the factors at play and explore the potential for a turnaround. Japan's economic recovery is like a car stuck in first gear. It's moving, but not fast enough. The economy took a dip in the last quarter, with real GDP shrinking because people's money isn't going as far as it used to thanks to rising prices. Imagine your weekly grocery budget buying less and less. That's the pinch Japanese consumers are feeling, leading to a drop in spending for the second quarter in a row. Here's the deal, the Bank of Japan has kept the money taps open, hoping to make spending easier. But with prices climbing faster than wages, folks are feeling the squeeze and holding back on spending. The real game changer will be when wages start to rise, which might not happen until spring 2024, when most companies sit down to talk about salaries. Meanwhile, the government's not just sitting back. They've thrown a lifeline with a hefty 17 trillion yen package, which is like throwing a big financial cushion to soften the blow from those pesky price hikes. Think of it as a series of measures like tax breaks and cheaper fuel aimed at giving people a bit more breathing room. As for the global stage, Japan's exports aren't strutting as confidently as before. Yes, there's been a decent uptick, especially with cars flying off to foreign lands thanks to a lineup of factors like strikes in the US and a hunger for vehicles post-supply disruptions. But that surge in car exports, impressive as it's been, might not last. The world's appetite for Japanese goods is cooling down, and the recent boost from cars could start to fizzle out as things like the US auto worker strike wrap up and the yen gain some muscle again. Speaking of the yen, it's been on a roller coaster. After hitting a low against the dollar, it started to climb back up, influenced by a mix of global financial moves and homegrown policies. This shift in currency scene is part and parcel of the broader economic landscape Japan is navigating. In Japan, the cost of living is climbing higher than what most people are comfortable with, hitting a 3.3% increase compared to last year. But here's the kicker. While the overall price hike is troubling, the real pinch is coming from the grocery aisle. Food prices soared by 8.6%. On the other hand, costs for services like haircuts or dining out nudged up just a bit to 2.1%, the highest since the late 90s. There's a silver lining though. The rate of price increases for goods has actually dropped from a steep 7.3% early in the year to a still toasty 4.4%. Now, you might wonder, what's the Bank of Japan doing about all this? Well, they've been playing it cool with their money policies, keeping interest rates super low, even negative, which is not something you see every day, especially when other big players like the US and Europe have been hiking rates to get their inflation in check. But whispers from the corridors of the BOJ suggest changes in the air. They're hinting at a possible rate hike soon, eyeing the first half of 2024 to start tightening the purse strings. Why the wait? They're hoping to see wages go up first. It's all about balance. Higher wages could mean people can afford to buy more without prices necessarily having to drop. But if they hike rates too early, it could stifle wage increases, keeping that vicious cycle of high prices spinning. So, here's where it gets interesting. The whole economy's like a giant seesaw. On one end, you've got rising prices, and on the other, wages trying to catch up. The BOJ's playing the role of the careful parent, making sure neither side hits the ground too hard. They're betting that if they can get wages to rise, it'll help everyone feel a bit richer and keep the cost of living in check without having to resort to drastic measures. In Japan, folks working at larger companies have seen their paychecks grow a bit, by about 2.3% compared to last year. Sounds good, right? But here's the catch. Prices are rising faster than that, so their actual buying power dropped by 1.6%. It's like getting a slice of cake only to have someone take a bigger bite out of it first. Now, while overall wages seem to be going up, the devil's in the details. The full-time employees aren't seeing as much of this increase. They got a smaller bump of 1.6%, and the smaller shops, they're even more stingy with raises, offering just a 1.5% uptick. Now, onto the job scene. It's a bit of a mixed bag. Unemployment's at 2.5%, which sounds pretty good, especially when you look around the world, but it's not as good as it was before all the global upheaval started, and jobs outside of farming, they're not as plentiful as they were, hinting that maybe, just maybe, there's a bit more wiggle room in the job market than before. But here's where it gets a bit more hopeful. Every spring, there's this big dance where companies decide how much they'll raise wages. it's a tradition known as Shunto. It's when big companies set the stage and everyone else follows their lead. Given that folks have been feeling the pinch, there's an expectation in the air that businesses might just open their wallets a bit wider this year to help make up for the rising cost of living. The Bank of Japan is taking its time, sipping tea while waiting to see if wages can catch up with rising costs before shaking up their financial plans. No hurry here, right? Especially if salaries aren't matching the living expenses. They're playing the long game, eyeing those wage trends closely. In Japan, changes in the air with potential interest rate hikes on the horizon. Quite the scene change from the days of low inflation and almost no interest. Imagine most Japanese families traditionally keeping their cash close rather than betting on the stock market. But now, with costs nudging up, whispers are spreading. Might people start diving into stocks? There's even a special savings account getting beefed up to make stocks more tempting. But here's the real thorn: Japan's towering debt. Over twice its GDP, easy borrowing days thanks to low rates might be ending. If interest rates inch up, Japan might have to pull the reins on spending or bump up taxes. Here's the clincher: Japan's economic engine is sputtering, with high prices and sluggish wage increases putting a damper on hopes for a swift recovery. Eyes are on this year's big wage negotiation moment, Shunto, which might just set the pace for better days or confirm the challenges ahead. Adding a layer of gloom, Japan's economy slipped into a recession. That's right, 2 back-to-back quarters of shrinkage marked by a surprising dip at the end of last year. This stumble has stirred doubts about the central bank's sunny outlook and its plans to roll back the financial safety nets put in place during tougher times. Economists like Takuji Ida from Credit Agricole are sounding the alarm, hinting that more rough patches could be ahead, especially with global growth slowing and Japan's own spending power weakening. And then there's the New Year's quake shaking things up further. Amid all these, the yen is hanging in there, not making big moves just yet, but it's like the quiet before the storm. Everyone's watching and waiting, wondering if Japan's financial wizards can pull off a turnaround or if they'll have to go back to the drawing board for 2023 and beyond. The Nikkei stock index managed to bounce back, climbing 1% after a previous dip. It seems like investors are crossing their fingers, hoping the Bank of Japan might keep the financial help coming a bit longer than we all thought. When we talk numbers, Japan's GDP took a tiny step back this quarter, dropping 0.1% when folks were actually expecting a 0.3% climb. It's a bit like expecting a step forward, but sliding back instead. Now, diving into the spending habits at home, things weren't as rosy as hoped. People weren't opening their wallets as much, leading to a 0.2% dip in private consumption. This is kind of a big deal since it's over half of what keeps the economy ticking, and those big projects companies spend money on also down by a smidge, just 0.1%, which might sound small, but was less than the sunny 0.3% increase everyone was hoping for. With the spring wage negotiations and global market influences on the horizon, could this be the turning point for Japan's economic fortunes? What do you think will be the key driver for Japan's recovery or continued struggle? Share your thoughts below, and don't forget to like, share, and subscribe for more insights.